Hi, everyone. It's Dr. Steph. I'm an assistant professor at the University of Toronto Faculty of Medicine, where I teach financial literacy and transition to practice. I'm also on Instagram and YouTube as Breaking Bad Debt. Today, I'm joined by Dr. Mark Soth from the Loonie Doctor Blog, and we're back again for part 2 of our videos on incorporation. All right, so this time we're covering how much to pay yourself if you're incorporated and how to determine the mix of salary versus dividends. We're going to be going through this walkthrough of the CCPC, or the Canadian Controlled Private Corporation Income Dispenser Calculator. And I'll link this calculator if you want to follow along with this video. It'll be linked in the description and above. And if you're on the Loonie Doctor blog, you can find this under financial calculators, under tax planning. For part 1 of whether you should pay yourself salary or dividends from your corp, their pros and cons, please check out this video, which I've linked in the description below. And if you find it helpful, please click like and subscribe. And if you have any questions, feel free to leave a question in the comments below. All right, so back to the calculator. So the first section is the disclaimer. So we are doctors. We're with an interest in finance. We're not financial advisors. So I just wanted to make sure that this disclaimer is on the screen.
Right. So the reason why I made this calculator is because if you have gone through our salary versus dividend talk, you'll realize there's a whole bunch of moving parts there. And the way you or I think when we're trying to think, oh, do I pay myself salary or dividends? Our start point is actually how much money do we need in our hands actually to spend, right? And we have to actually work backwards from that to say how much would I have to pay myself and how would I pay myself to get that amount of money in my hands after tax. And that's not an easy bit of math to do. And as mentioned in that previous talk too, there's also a whole bunch of nuances there, like income splitting and how much you have in different investment income in your corporation. So I made this calculator really to we can put it in inputs from our perspective, and then it'll run through a tax efficient algorithm in the background to try to use all of those nuances together and put it together to give you that amount of money you need after tax, working backwards essentially. So
Great.
That's what it's created for. And that's why there's the 3 tabs, because when you're talking about a corporation, there's multiple pots of money that actually all interact with each other. So we want to know how much money we need to spend. So that's got the spending tab. And then how we invest that money will have tax implications too. So with our investing tab, you go through some basic questions about your investing plan, like using your RRSP and your TFSA. And then the final tab is the tax planning tab, where we put in our corporate income and our personal income sources. And then it does all that math in the background and spits out a mix of salary and dividends, and actually gives a very detailed description of how that all plays out, so that you can then use that not only to have an idea about how to pay yourself, but also to print that out and take it when you go to talk to your accountant and see that that all kind of adds up for your situation.
Sounds good. Okay, so I'm going to click the spending plan. I'm currently not married, so I'll click no. I'll put in my age and my province. And so here, in terms of target lifestyle spending, how do we kind of determine what to put in this category here?
Yeah, so that would be your after-tax spending for your lifestyle, basically regular stuff, including debt payments. So if you have, mortgage payments and car payments and those kind of things, how much money do you need to pay for your food or housing and your debt repayment plan? Just on a year-by-year basis.
By yearly basis, right?
On a yearly basis, yeah. Everything for this is just 1 year at a time.
Around this would be the amount approximately that I spend on a yearly basis.
Good. And that sort of after-tax money is the way that most of us would think when we're looking at our budget. We're not thinking how much we need to get to have that. That's what the calculator is for. So the other part we want to have is that's like our regular day-to-day budgeting. But let's say we have a big expense plan sometime in the next few years. We want to smooth out that income. We don't want to take it all out in 1 year and have a massive tax bump. We usually want to spread that out and do some income smoothing. So that second bar below is if you do have something like that. So let's say you want to buy a car that's $50,000.
Yeah, more likely than not, probably looking to buy a home, for example.
Okay.
And if I'm planning to save up the down payment, let's say 20% down payment, I'm going to assume this as the down payment.
Okay. And do you have a rough idea about how many years that would be from now?
Yeah, so maybe about, let's say 3 years from now.
Okay, so 3 years. So what that does is, and then it gives you the option whether you want to use that to plan for your income smoothing or not, because you may not. If some people don't want to do that because they're so uncertain, they would just click no in that box.
Mm-hmm.
But you put yes. So what it does is it takes that $250,000, and if you press enter so that your cursor comes out of that box, it
Yeah.
should calculate that. If you click down at the bottom of the page, you'll see that it says it's going to save in excess
Yes.
$83,000 a year,
Mm-hmm.
$80,300 a year for that splurge. So instead of taking that $250,000 out in 1 year, 3 years from now, and having like a massive tax bill, you'll take $83,000 out each year for the next 3 years. And it actually will add that in to that $72,000. So when it does the calculation, it's going to be looking to take a basically, 150,
About 150 or so, right?
yeah, $150,000.
Gotcha. Okay, sounds good. All right, that makes sense. And it's good to know that I should plan to save this much ahead of time in the 3 years leading up to when my home purchase is going to be.
That's right. That'll help. I actually put an article just this week about that with an example. And
Sounds
you've done
good.
your video as well. So
Yeah. Okay, so let's move on to the second tab, which is investing plan. Now, this comes with two categories. The first is income split. And you wrote here that this is for if I have a lower income spouse. And the second section you had is cost split, which is if we split our income split our lifestyle costs kind of equally.
right.
So,
So this only matters if you're married. If you're not married, it doesn't
it doesn't really matter what I put,
doesn't
right?
impact anything. But if
Okay.
you are married and have a lower income spouse, if you want to have the optimal household income, then you'd use income splitting, and that'll direct who contributes to the TFSAs and who gets to have the personal account in their name, if you have excess money left over to do that efficiently. That's the best way from a household to plan your income and your expenses. But some people psychologically just don't want to do that, and they'd rather just split everything 50-50 regardless of whose income is what, which probably is less efficient as a household, but some people still do that.
Got it. So I guess in my case, if I'm not married, I'll just leave it as is for now. Okay. All right. So here I'm going to ignore the spouse category and only put in my own category. So would this be my TFSA contributions to date so far?
No, it'd be for this year that you're planning.
Just this year, right?
Yeah.
Okay. So I believe this year it would just be the maximum, which is $6,500.
Right. And that's $6,500 after tax. So the calculator puts that in as part of the cash flow you need to get personally so that you can then put that into your RSP.
Right.
The same thing applies to an RESP.
Gotcha. And if, let's say, someone hasn't maximized their TFSA room yet, this contribution number potentially might be higher if they have all that other room built up. But since I've maximized it up to this year, if I still had this year's room left, it would be the $6,500 for this year.
That's right.
Okay. I don't have a child, so I don't have RESP contributions. But for someone who does have a child, they would determine how much RESP room they would have for that year, right?
That's right. Yeah.
Okay. All right. So now we're moving on to the RRSP section. So this is pre-existing RRSP room. So this is all the RRSP that I have contributed to date, right?
Well, it's how much room you have left over that you haven't used. So if you've had room and you've used it every year, then it's just going to be whatever you've got that you're going to generate. It would just be zero. But if you, let's say, generated RSP room, say with your resident salary, but you didn't have money to put into it, then you've built up RSP room that you can now use. So it would be that unused RSP room that you've got.
Right. And so people watching would find this out either through their CRA account or ask their accountant to let them know what that is.
Yeah, it should come on your notice of assessment that you get after your income taxes.
Exactly. So since I've maxed my RRSP for this year, I would probably just put zero for this.
That's right. You would just put zero for that. And some people will have contributed to their RRSP, but not used the deduction yet. So someone might decide not to use the deduction right away because they know they're going to have a big income bump in the very near future from, that could be from a massive income increase, like moving from residency to practice, or it could be commuting a pension, for example, or you sell a piece of personal property or real estate or something that you have to pay tax on. So you may want to use the deduction in that year where you have that extra money. And that's why there's contribution strategy and deduction strategy boxes. So if you are going to have a big income bump that you would want to save for, and you really want that to be in the next couple of years. If it's not, then you're missing that opportunity to have tax sheltered growth. But if it is going to be the next couple of years, you can change that to limit, and then it'll allow you to limit how much you're going to contribute or how much you're going to deduct to a certain amount, so that you're saving that room for whatever is going to be that big influx of money or that big increase in your income.
So if you're a resident watching this, then maybe you might want to click limit because you haven't really reached your maximum or higher salary yet. So in my case, I will just put as max, just because I've actually already used up all my RRSP deduction room in my previous tax return.
Yeah, and you've got the money to put in, and you would be able to use it. So if you have the money to put in, then you would just leave that as max for contribution. If you want to save the deduction for the future, you'd put a limit there. But if not, you would just you would just leave it as max. And if you wanted to save it all for the future, like put the money in now but not deduct it, you'd make that limit 0.
Oh, I see. Okay, so put it.
That would carry it for the future to use.
Gotcha.
Now, the one other thing to know about the RRSP planning is that this actually uses what's called a dynamic salary strategy. So Ben Felix and Braden Warwick did a paper on that with IPPs, and I've done some work with that with RRSPs and corporations. And using a dynamic strategy rather than just paying yourself to maximize the RRSP room every single year, or a dividend only strategy every single year, the dynamic strategy usually works out to be a bit more efficient. So what it does is it'll pay you enough salary to make your cost of living needs, but also be releasing all of the refundable taxes within your corporation. Whereas if you didn't need very much money, you might be just losing a bunch of tax deferral by paying yourself extra salary that you didn't need, which is not as efficient. So it does that for you.
Okay, sounds good. So let's move on to this last section right here. So do you want to just walk me through what this means here?
Yeah, so that section, it's got numbers in there right now, but it won't really be an accurate population until after we do the tax planning. So what happens is when you do the tax planning tab, which is the last tab, that will find an efficient way of moving the money out of your corporation. And sometimes that means taking more money than you actually need right now because it releases refundable taxes to your corp, or there's a good opportunity to move it out at a very low tax rate, in which case that extra money would get invested in a personal account.
So why don't we do the tax plan first and then come back to it?
Yeah, and the reason why I put it there is because if you print out everything, you can have an idea of your investing plan, your spending plan, and your tax plan all on a piece of paper for yourself. So
perfect, and that'll be really helpful for the accountant as well.
Yeah,
great. Okay, so here, corporate active income. So this is the total of how much I would make in a corp before my own salary and things like that, right?
Right. So this is just the net income from your business, from the business income. So if you have a practice and you make, say you make $450,000 after overhead, so you've paid all your office expenses and everything else.
Oh, after overhead. Okay,
that's
so
right.
Like this, yeah.
So say you had $450,000 in business income, you had $50,000 in office expenses, it would be $400,000.
And just to make sure, let's say if you have real estate in the corporation, that wouldn't be counted, it would be passive income. So it'll be shown somewhere else on the calculator.
Yeah. So for most physicians, that's true. If the income is used as part of your practice, like if the real estate is part of your practice,
right,
then sometimes it can count as active income. If you have a primarily real estate type corporation that has employees and people that work for the real estate company, then that might be active income. But for most people, it's actually passive because you're not providing other services. You're just renting out a space. And there's details with that you'd have to talk to your accountant about. For most of us, it would be considered passive income.
Correct. Okay. And so what would I put here? Corporate retained earnings as cash available.
Yeah. So if you just have a bunch of operational cash sitting in your corporation that you're not really needing, but you don't have it invested either, then that's cash that's available to move out efficiently. So the calculator in the background does work, and it tries to avoid selling investments and things like that just to move cash out, because then you're going to trigger other taxes. It will do that if it's efficient to do like a capital gains harvest type of maneuver, but otherwise it doesn't. So it won't try to dispense more money than you have in your corporation, because that means you're going to have to be selling some of your investments.
Right.
So that's why that field is there.
Right. And so because I'm less than 500,000 in active income, then I would qualify for the small business deduction rate.
That's right. And in Ontario, it's pretty much that simple. If you're in Quebec, there's a few extra tabs because in Quebec, you also have to have enough full-time hours work of employees to also qualify. And that also, there's a difference between the federal small business rate and the provincial rate in Quebec, which is why I've kind of put federal there, but it would apply both for most provinces except for Quebec. And in Quebec, it actually does a bunch of other things to account for that wrinkle in their tax code.
All right, so here we're moving on to the corporate passive income. So it's asking us for last year and current year. So for this type of information, where would one usually find this information for this section?
Yeah. So for last year, you could look on whatever your investment statements were that you gave to your account at tax time. And often because corporations don't have a calendar year as the year end for their fiscal year, the easiest way is probably actually to look on your tax return for the corporation or ask your accountant what it was for last year. And the reason why it does this for the previous year is because that gives us what's called the aggregate investment income, which is when you add up all the passive income like dividends, passive rental income, which would fit into the other category, or foreign dividends, that type of thing, or the taxable part of a capital gain, then all that counts as passive income, which can affect your small business threshold. And it's the previous year that affects it for the current year's business taxes. So that's why it has it for last year. And then it can, if you know what it is for the current year, the reason why it asks for that is because you can plan that, let's say I'm getting $30,000 of eligible dividends. Well, I probably will want to give $30,000 of eligible dividends out to myself to release all those refundable taxes. So the last year helps you with the passive income threshold, and the current year helps you to be the most efficient you possibly can with the investment income that's coming in, making sure that you release all those taxes.
Gotcha. And so there are, in one of our previous videos, the one that compares the different asset allocation ETFs, you had talked about the corporate class ETFs products from Horizons, which doesn't actually generate any eligible dividend income. So for folks who are investing in those in their corp, they would probably leave the section as 0, right?
Yeah, it makes it very simple. Yeah.
Okay, sounds good.
From that aspect, there's other risks with those corporate class ETFs as well.
Yes, which we touched on in that video as well.
Yeah.
Okay, so I'll put approximately 3,000 for here. This current year, assuming that I've invested in the same thing this year as last year, I would assume it would be approximately the same as well.
It's going to be the same, or maybe a little bit more just because you invested a bit more. And, again, none of this has to be perfect.
Yeah.
Because like the calculator gives a very, very precise estimate of everything, right? But you can always look towards the end of the calendar year and then make some small adjustments if you want to.
Correct. And then it also asks about corporate interest. So this is like if you're investing in like put your money into a high interest savings account, things like that.
Yeah. So anything that generates interest or foreign dividends or other investment income, like from real estate, net income.
So then since the current year hasn't exactly finished yet, would you just suggest putting the same as last year?
Yeah, I would just put the same as last year. It's probably going to be very similar, right?
Okay, sounds good. And then what would you put here? Realized capital gains.
Well, you only put something there if you've sold some investments and realized a capital gain on it. If you haven't, then it would be 0.
I see. Okay.
And
so
if you had, then you would put the gross amount. So let's say I had a $50,000 capital gain.
Mm-hmm.
I would put $50,000 there, knowing that, only half of that is taxable.
Gotcha.
See,
there we
made
go.
it to 5,000 right there.
Got it. Okay, great. All right. So now we're moving on to the corporate notional accounts section. Okay, so the capital dividend account, where would one usually find this information?
Yeah, so for all of this section, if you happen to know what they are, it's great because you can use one, it makes you check that they've actually been emptied out so that you've actually paid. These are all basically taxes that have been collected from your corporation, but some of it's in this notional, which is an imaginary tax account that is money that your corporation can actually get back refunded if you use them properly. So you want to make sure they've been emptied out if you've been able to do that. So looking on your corporate tax return could help you. although most of us get lost trying to look at our corporate tax returns. So the easiest thing is to ask your accountant, what's the balance in my capital dividend account, my GRIP account, my refundable dividend accounts, which would be eligible or non-eligible.
Mm-hmm.
And then you can put those numbers in there. If you don't know them and you leave it zero, that's okay. The calculator still works. But if you put them in there, then the calculator will try to empty those accounts out if it's tax efficient to do so. So it may pay you some more dividends to try to empty those out up to as long as that's efficient, because sometimes the refund is less than what you pay in personal tax.
Right.
In
Okay.
which case it wouldn't do that. It would leave that money in there for a future year for you to take out.
Okay, so I'll leave them at zero for now, and I'll probably ask my accountant what is in each of these accounts. Likely for me, I won't have any in the GRIP just because my active income is less than the 500,000.
Well, you might have some in the GRIP. Yeah. So you might have some in the GRIP that's been generated by eligible dividends too. So if you've got an eligible dividend income and you didn't pay out eligible dividends, then that GRIP is your ability to pay out eligible dividends. So some people may have not taken advantage of that, even though they've had the money in there. So it's actually worth asking your accountant.
For sure. So maybe just for the audience's information, do you want to quickly just go over what is capital dividend account, GRIP, eligible refundable tax on hand, and non-eligible refundable tax on hand, just so that the audience kind of knows what each of these things are?
Yeah. So there are ways to, so the capital dividend account is when you realize a capital gain in your corporation, half of that capital gain goes into what's called the capital dividend account. And that gives you the ability to give yourself a special dividend called a capital dividend, which is tax-free. Mm-hmm. So if you earn that money normally just yourself, half of it would be tax-free. So this is the way of simulating that within a corporation where half of it would be tax-free. So it's important to know that if you've been realizing gains in your corporation, because it's a great way to move money out efficiently. The GRIP stands for General Rate Income Pool. And what that means is that's income that's been taxed at the high general corporate tax rate. So a big company pays around 27% or more tax, but they generate this GRIP, which allows you to pay out eligible dividends instead of the more expensive ineligible ones. So the idea is that since the corporation's paid more tax, you pay less tax personally, and it all adds up and works out to be integrated. So way you get that is, one is if you are over the small business limit of $500,000, or if it's been shrunk by the passive income limits, then less. Or if you've collected dividends from a big company that's already paid general corporate tax. Let's say you have bank shares. That bank pays tax at the high rate, gives you an eligible dividend to your corporation, and that allows your corporation to also pay an eligible dividend out to you. So that's what the GRIP is. And then the refundable dividend taxes are a system that's set up to prevent corporations from just having a tax deferred investment money. So what happens is when you get a eligible dividend, it's taxed at close to the highest personal rate at 38.3%. And that also goes into what's into this refundable dividend tax account. So it gets charged that tax up front, but there's this refundable tax that it gets that tax back when it pays you an eligible dividend. And then you, of course, pay personal tax. So it taxes the income up front, and then it gets released when you pay yourself. Mm-hmm. And the non-refundable tax is the same deal, except it's for interest and foreign dividends, that type of thing. There's a few little other nuances in there where it's not as efficient as eligible dividend tax. So you pay a 50% tax rate up front, and your corporation gets 30% refunded when the money moves out to you, and a little bit less if it's a foreign dividend.
Right, that makes sense.
So basically, the bottom line is, if you have money in those accounts,
mm-hmm.
is that you want to try to empty them out if it's efficient to do that. And if you try to save it for the future, well, they're going to be worth less in the future because they're priced in nominal dollars or today's dollars, and that's going to erode with inflation. So if you have money in there and can efficiently move it out, that's generally the tax efficient way to do it.
Right. So when let's say if I just put in some random number in there, it will kind of remind you to move it out in the next year, right?
Yeah, and when you start to put in everything, it'll tell you how much, that it's got.
Okay, so. Sounds good. All right, and then what are these sections for here? Minimum threshold and accountant fee.
Right. So I mentioned that capital dividend account, which is the money that goes into it's not really money, but it's kept track of that you've got this tax-free capital dividend generated money. So to send that money out to yourself, you have to do a special election, which is a bunch of paperwork the accountant has to do. And they're going to probably charge you a fee for that. Some of them will count it as just part of your regular corporate tax filing, but some will charge a fee. So you don't want to just move it out if you're being charged fees for it. Don't want to move out $100 when you're paying a $300 accountant fee. So for me personally, I just preset it at $25,000, which is totally arbitrary. But if I've got that money sitting in the capital dividend account and it's more than $25,000, it's probably worth my time and the $300 or whatever it costs me to move that out from my capital dividend account into my personal hands and then invest it tax efficiently that way.
Gotcha. That makes sense. All right. So now we're moving on to the next section, which is corporate tax calculation and payout strategy. So now you have two separate things here, dividends only and salary and dividends. How would you decide which one to choose between the two?
Yeah, so I've pre-selected it as salary and dividends because that is probably the most efficient way of paying yourself from your corporation. And what it'll do is it'll use enough dividends to release all those refundable taxes I talked about, and then pay the rest out as salary because that gives you RRSP room, and it's also a little bit more tax efficient from a tax integration standpoint. So it is the most efficient way to do, but I know there are people who just want to pay dividends. They don't want to set a payroll up, and their accountant, for whatever reasons, is dead set against dividends, although that mixed strategy usually comes out ahead in the long run. So I did put the option for dividends only if people are really adamant about doing that. Now, it will tend to give more dividends and less salary depending on your ability to income split. So if you're able to income split with your spouse, and I don't think that section showed up in what we're showing here because it does, I hide it when you're not married. So when you're married, there'll be a section asking you whether you can pay yourself or pay your spouse a market rate salary, how much that is, and whether you can pay them dividends before the age of 65. And it'll factor those in to try to take advantage of paying them a salary and income splitting, use the dividends if they're allowed to do that when it starts to make its mix of salary and dividends. So salary and dividends is the way I would set this. That way it sort of optimizes all of those nuances together. Right. Dividends only makes it dividends only, whether it's efficient or not. But I mean, there's people that want to do that.
So what are some things that I should be focusing my attention on here?
Right. So this, before I got into this, I would actually just check down at the bottom section to make sure you have your personal income sources in. So in the personal income input section, let's say you get some salary income from some source other than your corporation, like maybe the university that you work at or whatever, you can put that in. If you have, so let's say you get a university salary, like, $10,000 or $20,000, you can put that in there. Okay. And that counts towards your cash flow and counts towards your taxes. And let's say you have personal investments that have some eligible dividends or interest, or you have personally held real estate investments, then you could put the net income in there for your personal investments because that's all taxable income. If you put what that is, this will actually count that as part of your income and tax you on it.
Gotcha. Okay. And then here we have personal investment capital gains. This is only if you actually realized those capital gains.
That's right.
Okay,
Yeah.
So I haven't done that yet.
Yeah.
Okay. Sounds good.
So this will then tell you how you would pay yourself. So this would say to, and remember, it's going to be more than your baseline living expenses because it's trying to take out an extra 80-something thousand a year after tax because you're saving for that house. So it would say to pay yourself salary about $209,000. If you had more investment income, it would probably be less because you'd be paying out more in dividends, right? So it's not so it's not trying to give you any bonuses and anything like that. It also calculates there's the CPP employer contribution because you paid yourself salary. And then it shows a rough estimate of the tax on the active income for your corporation there. Okay. So the net corporate active income would be how much money your corporation's brought in after overhead, and then your salary and the CPP that your corporation pays to pay you counts as an expense, right? So that lowers your corporation's income, and then that's subjected to corporate tax.
Got it. Okay, that makes sense. And so now we're moving on to passive income and taxes section.
Yeah, so the passive income limit, you still have quite a bit of a limit there because of your, you didn't have a lot of passive income the year before, so and active income level. So it looks at that. And it looks that you would have collected, your corporation would have paid, for refundable taxes, would have paid 1,150 taxes in ERDTOH. And because you're giving out eligible dividends, which it'll show you in the lower section, that all gets refunded. So you're getting all that money out of there, which is great. It's what you want. For other income tax collected, you're getting, if your corporation paid $20,000 in passive investment income taxes, and you're going to get 12,000 of that refunded back from the refundable dividend taxes, because you're also paying yourself ineligible dividends. So if you go in the next section below, it says dividends to be paid out. So you've got your salary up there, dividends paid to yourself. You'd be paying yourself 3,000 in eligible dividends to release all of that, and 32,000 in ineligible dividends as well. So that leaves $170,000 in your corporation to invest as retained earnings. And then if you go down to the bottom, it'll show you the total taxes that you've paid, both for you personally and for your corporation. And then the total amount of CPP, because you paid both the employer side and the employee side.
Right. That makes sense. So knowing all of this information, what are some action items, like concrete action items, I should be taking? One of them that comes to mind is I should be paying out this amount, 35,000 in dividends, in addition to my salary. Any other action items people should think about when they put their numbers in here? Anything else that they should be talking to their accountant about? Or
so in this case, I would use this again. This would be a talking points for my accountant. I wouldn't just go and write myself a check for the big dividend or just bump up my salary without talking to my accountant. I'd say, look, this is what I figured out to give me the money that I need. And I'm talking about for my current expenses and putting money in my RRSP and in my TFSA. And that seems like you're taking a lot of money out of your corporation, because you're going to put money into your RRSP, you're going to put money in your TFSA, you're going to save some money for that down payment, and you're going to pay for your living expenses. So it's counting all of those things in together, which is why it seems like it's taking out more than most people probably realize, because people don't realize that, you take out that money, but you're then contributing it to your RRSP. So you need to have that money to actually contribute it, right? So I would use this as a talking point for my accountant, and then say, look, this is what I'm thinking to put my salary and dividends to, because these are all the things I want to do with my money. Does that make sense? That would be my action item. And then the other action item would be, do I have if I didn't know what was in my notional accounts, to talk to my accountant and say, look, what's in there? Am I getting everything released, or is there something I don't know about? Because it's very common that people have money sitting in those accounts that they haven't released because they haven't paid themselves dividends to release it, because they didn't realize that was actually an issue. They paid 38 or 50% tax up front, and they don't have they could get that bunch of that money back if they actually paid themselves the right way. So that'll be the other action item. And the final action item would be, if you go down to the very bottom of the screen, in this case, when you look at the total taxes and personal cash flow, there is no excess there. But let's say there was an excess amount there, you'd have to think of what you're going to do with that, because sometimes you pay less tax overall when you're moving money out of your corporation because of those refunded taxes. Well, you have to know what you want to do with that extra money, and that may mean opening a personal investment account to put that money in and invest it. And
in what kind of cases where people would have this excess money left over?
Yeah, so we've had this happen because we've done a capital gains harvest. We've had a bunch of capital gains that we've realized we're able to spend, and we did it because I can then use that excess money, and my spouse can invest it in her name at a very low tax rate. So that's one of the times where it makes sense if you have a very low income spouse and you're able to move that money in efficiently. Other times where you may have some excess money is, let's say you're in a relatively low personal tax bracket, but your corporation's getting a bunch of eligible dividend income or other investment income. Well, it's getting taxed at that high rate in the corporation. And if you're paying a lower personal tax rate, it makes sense to take that money out as a dividend, pay the lower personal rate. Like, say your personal tax bracket's 30%. Well, you pay that 30% tax, and your corporation gets refunded 38% for eligible dividends and 30% for ineligible dividends. So the amount of tax you've paid overall is actually less because your corporation got refunded more than what you paid personally. And when you invest money personally, it's often a bit more efficient than a corporation, except to the highest possible tax bracket.
Makes sense. Okay, so I remember that there was another section under the investing plan down here that we wanted to come back to.
You're right.
So
So yeah, so this section down here, if it matters more if you had excess money. So here you don't. You can see the bottom, the green sections are all zero. You didn't have any excess money. But if you were to income split with your spouse or split your spend cost split, it would show, how much of your cash flow comes in, who's paying what amount for the living expenses. It shows how much money is going into your TFSAs and who's paying for that. Like if you're income splitting or cost splitting, the high income person would put in the TFSA money for both. And then who's contributing to the RRSPs and the RESPs. So it basically is kind of like a final cash flow and what excess money goes where type of summary.
got it. Okay, so if you do have a spouse, this would be really helpful to know how much, if you are the high income earner, how much you put into your spouse's, like tax advantaged accounts, correct?
That's right. Yeah.
Okay.
You would be able to do their TFSA. They would have to contribute to their own RRSP.
Mm-hmm.
And if there's an RESP, the higher income spouse could contribute to the RRSP. It doesn't matter so much for those if you're relatively the same income, but if you have a lower income spouse, the more of their income you can preserve, that they can invest that in their name, then you can start to build this personal low taxed pot of money.
Great, sounds good. Okay, so thank you so much for showing me how to use this calculator. So if there's any questions about this particular calculator or any of the topics that we discussed today, feel free to leave a comment in the description below and let us know if there's any issues working on the calculator. Mark can definitely fix that as well.
Yeah,
So
if you can
thank you so
break
much.
if you can break it, I want to fix it.